You're listening to the Limitless Wealth Method Podcast. Smart ideas, real strategies, and candid conversations for business leaders. Here's your host, Jason Hilliard.
What's up, everyone? This is Jason Hilliard, and welcome back to the Limitless Wealth Method Podcast. My effort to share the ideas, strategies, and insights that help entrepreneurs, executives, and investors build wealth and live without limits. Every week, I'm pulling back the curtain on money, leadership, lifestyle, fitness, mindset, and emerging tech. Basically anything that can help you perform at your highest level. So if you're getting value from this, it would mean the world to me if you would subscribe on your favorite platform, watch episodes on YouTube, and share it with just one person in your network who'd get something out of it. My goal is simple: help you grow your wealth and your life one episode at a time. Let's get into it. Today, we're going to tackle a big question, and I'm going to do my best to make it more plain English. And the question is, why are risk assets correcting? And why is the Federal Reserve at the center of it? Under the surface, there's a much bigger story. Number one, the Fed is falling behind both the interest rate and repo market liquidity curves. In other words, or in simple terms, the Fed is reacting to yesterday's conditions while today's funding markets are already flashing warning lights. Global liquidity is tightening, and the institution that's supposed to stabilize the system is actually amplifying the stress. We're going to also talk about what's happening in the markets right now, why the Fed's policy stance is still too tight, why the Fed needs a structural regime change, and how the Powell Fed's track record has helped create the mess we're in. So let's get into it. Let's start with the immediate question. Why are risk assets correcting? Well, recently the Fed made a directionally hawkish pivot. Traders had been pricing in a December rate cut with pretty high confidence. Then multiple Fed officials came out this week and last week and really questioned the justification for a third consecutive move, pointing to economic resilience and sticky inflation. And the result is the implied odds of a December rate cut dropped to roughly 50-50. The US dollar broke out, bond volatility spiked, and risk assets, equities, credit, and anything that depends on easy liquidity starting to wobble. That's not random. This misguided hawkish pivot is causal to what you're seeing in the markets. And it's happening because the Powell Fed still doesn't fully understand the role the institution needs to play in this fourth turning moment and the K-shaped economy crisis, which I'll explain a little later. But over the next few weeks and months, markets may punish them and by extension investors unless they start to realize they're on the wrong path. Before we talk about regime change, let's remind ourselves what the Fed is actually for. The Federal Reserve was created in 1913 because the U.S. banking system used to be chaotic. There was no central bank, there was no lender of last resort, and there was no coordinated way to manage the money supply. Every few years, we'd get a major financial panic. We'd get bank runs, collapsing institutions, frozen credit, and the panic of 1907 was really the final straw. So Congress stepped in and said, we need stability. We need a backstop. And then the Fed was born, and they had three core missions. Number one, stop banking panics by acting as a lender of last resort. Number two, create a flexible money supply so the economy could expand without constant breakdowns. And number three, centralize the banking system into a unified nationwide payment network. In other words, the Fed was created to keep the financial plumbing from exploding every decade and to give the U.S. a modern monetary backbone. Now, whether it solved the old problems or just created new ones, that's the story we're living through. To understand what the Fed is doing today, you have to understand its dual mandate. Number one, price stability. It keeps inflation low and predictable, and then maximum employment, which keeps the labor market as strong as possible without causing runaway inflation. Price stability doesn't mean zero inflation. A little inflation certainly helps an economy grow. The goal is stable, predictable inflation so families and businesses can plan. When inflation runs hot, the Fed raises rates to cool demand. And when inflation falls or the economy weakens, they cut rates to stimulate activity. That's really the steering wheel. Maximum employment doesn't mean zero employment. There's always going to be people between jobs. The Fed is aiming for the lowest unemployment rate the economy can sustain without overheating. So the dual mandate is constantly kind of a balancing act. If you tighten to tame inflation, you risk slowing job growth. If you loosen to support employment, then you risk reigniting inflation. Everything the Fed does, rate hikes, cuts, balance sheet expansion, QT, forward guidance, flows from those two marching orders. Now, what data are they actually watching? So there are a number of data points they focus on: inflation, employment, GDP growth, financial conditions, banking and credit data, consumer sentiment, and global conditions. But here's the problem. Most of what they rely on, the unemployment, the CPI number, the GDP number, consumer sentiment, lags the business cycle. By the time those numbers move, the markets have already moved and the real economy has already turned. They're driving the car by looking in the rearview mirror. Now, let's define a term that matters right now for a lot of what people are feeling on the ground. And that term is positive real policy rate. And I'll explain why that moniker or that definition is so important. In simple terms, the policy rate is the Fed's main interest rate, or the federal funds rate. The real policy rate is that rate minus inflation. So if the Fed funds rate is 5% and inflation is 3%, then the real policy rate is 2%. That's considered a positive real policy rate. But what does that mean in real life? It means borrowing is expensive after you adjust for inflation. It means the Fed is actively pressing the brakes on the economy. And it also means households, small businesses, and interest rate sensitive sectors feel like they're pushing uphill. As long as the Fed keeps the real policy rate meaningfully positive, policy is restrictive. It slows growth. It tightens financial condition. And it hits the bottom half of the K-shaped economy the hardest. We currently have positive real policy rates. The K-shaped economy crisis will persist as long as the Fed maintains a positive real policy rate in this environment. Now, layer on top of that, the fiscal situation. The U.S. is running a large fiscal and external deficits at the same time. As global liquidity tightens and interest rates stay high, funding this deficit becomes harder. It puts pressure on growth, on the U.S. dollar, and on U.S. financial assets. Because the deficits are so large, policymakers are in a macroeconomic no-win zone. If they tighten policy to reduce inflation or debt, they risk slowing growth and triggering funding stress, which what we are seeing right now. If they loosen policy to stimulate growth, it worsens both deficits. Really, the only possible way out eventually is some combination of monetary debasement, which is really just allowing inflation to run higher to erode the real value of debt, and financial repression, which is keeping interest rates artificially low so debt service stays manageable, even if investors earn less in real inflation-adjusted terms. That's the backdrop for why the Fed needs a structural regime change. It needs one. It hasn't started yet. And whoever the next Fed chair is, after Powell steps down, will have to understand that and act on it. Let's talk about what I call the K-shaped economy and a concept that sounds technical but is very intuitive, which is housing velocity. First, the K-shaped economy. At the top of the K, wealthy investors and asset owners are doing fine, often great. They benefit from higher yields and asset inflation. At the bottom end of the K, you have low to medium income households, small businesses, and interest rate sensitive sectors have effectively been in recession since 2022. Now, what is housing velocity? In plain English, housing velocity is simply the speed and volume of activity in the housing market. How often homes are being bought, sold, built, and financed. High housing velocity means people are moving, homes are being built, mortgages are being originated, and construction and related industries are busy. Why does this matter? For every home built in this country, we hire roughly 3.1 people. It's very hard to AI your way out of physically building a house. Housing is critical for labor mobility. If you lose your job and you need to move for an opportunity, you need a functioning housing market. Right now, young people who are borrowers, not savers, are struggling to buy homes. That's how they traditionally build wealth. When housing velocity collapses, their path to wealth building gets blocked. And here's the kicker. Housing is also tied to inflation through shelter costs. Some of the stickiest drivers of inflation today are healthcare, education, insurance, and shelter. You can't do much about healthcare or insurance with the interest rate tool. But if you lower rates, stimulate housing velocity, and get more homes built, you increase housing inventory, you take pressure off of rental rates, and you start to bring down shelter inflation. So the same policy that supports labor mobility and wealth building also helps with one of the stickiest components of inflation. Now we need to talk about the elephant in the room, the Powell Fed's track record, because our current problems didn't come out of nowhere. They sit on top of a series of policy errors. Here are 5 major mistakes of the Powell Fed. Number 1, too late to stop tightening in 2018. The Fed kept tightening into a weakening environment, and it helped trigger a sharp risk-off episode and had to reverse course. Number 2, they were too late to respond to a global pandemic in 2020. The response eventually became massive, but the initial hesitation and communication missteps added uncertainty in an already fragile moment. And they were asleep at the bank supervision wheel in 2023. Regional banks blew up because duration risk and basic asset liability mismatches weren't properly supervised in a rising rate environment the Fed itself created. Number 4, they were too late to ease into an obvious labor market contraction in 2025 this year. The Fed stayed tight even as forward-looking indicators and real-world conditions showed the labor market was weakening beneath the surface. And number 5, letting the inflation genie out of the bottle after 40 years. After decades of relatively anchored inflation, the Fed fell behind the curve, allowed inflation to surge, and then had to slam on the brakes, creating exactly the kind of instability it's supposed to prevent. The point is not to nitpick every decision. The point is, this is a pattern. The Powell Fed has relied heavily on lagging data. They reacted too slowly at critical turning points, and in the process, helped create the very instability it claims to be managing. Our current problem, which is tight policy, positive real rates, and a suffocating K-shaped economy, sits on top of that littered tenure. So where does that leave us? Our research says the Fed doesn't just need a tweak, it needs a structural regime change. And that change has not started yet. The next Fed chair, the person who follows Powell, will need to understand 3 things. Number 1, you can't run policy off lagging indicators forever. If you're always reacting to yesterday's inflation and last quarter's jobs report, you will always be late and you will always overshoot. 2, you can't ignore the K-shaped economy. It's not enough to say aggregate data looks fine when 65 to 70 million low to medium income households have been in recession since 2022. And number 3, you can't pretend fiscal discipline is coming. There is a durable, bipartisan commitment to fiscal largesse. This government is not going to stop spending more money. The Fed has to operate in that world, not in a fantasy world where deficits magically shrink. That's why we talk about structural regime change. The Fed needs to rethink how it balances inflation, employment, and long-term interest rates. It needs to stop treating the 2% inflation target as a law of nature and start recognizing the constraints of a heavily indebted, aging, K-shaped economy. It needs to move from a mindset of crush inflation at all costs to maintain system stability and broad-based economic health. Again, this hasn't happened yet, but it has to happen, and it will fall on the next Fed chair to drive that shift. If the next Fed chair, or even this Powell Fed, actually pulls off a true structural regime change, we should see that show up in the data, not overnight, but over time. You'd expect improved economic activity across a broad range of U.S. data series, a healthier balance between inflation control and employment, and less of this extreme divergence between the top and bottom of the K-shaped economy, and an increase in liquidity that supports a more risk-on environment, which would tend to push asset prices higher over time. It wouldn't magically solve the debt problem. The debt challenge is still there, but it would create room to move forward. It would give households at the bottom of the K-shaped economy firmer footing. It would ease some of the pressure on small businesses and housing, and it would make the overall system more resilient instead of constantly one shock away from crisis. That is the opportunity, not a perfect world, but a more balanced regime where the benefits of growth and stability are shared more broadly instead of concentrated at the top. Let's tie this back to how things feel on the ground. All right, so if you blend interest rates and the size of the Fed's balance sheet into a single measure of how tight or how loose policy is relative to history, you get a simple picture like you'll see in this chart. Readings above zero means policy is restrictive and slowing the economy. Readings below zero, policy is accommodative, supporting growth. Every time those readings move far above zero, the economy eventually hits a wall. You see high readings, then a recession. Right now, we're back in positive territory. If you look at the chart on the left, you'll see that black line. That tells you that we're back in positive territory and not just slightly. Restrictiveness today is in the same ballpark as the period before the 2001 recession, the 2008 financial crisis, and the 2020 shutdown. Meanwhile, the Fed is saying inflation isn't at 2%, so we're keeping the pressure on. But for households and small businesses, especially at the bottom of the K-shaped economy, conditions already feel tight. You have higher borrowing costs, higher housing costs, and slower credit growth. Also, we have softer demand. So policy is too tight for the real economy, even if the headline inflation numbers haven't drifted back to 2%. And remember, that 2% target is a policy choice, not a law of physics. The Fed treats 2% inflation like it's some kind of sacred number. It's a policy choice. Our research actually projects an equilibrium core PCE rate in the high 2s to low 3s. In other words, the real steady state for this economy is closer to 3% inflation, not 2%. So when the Fed keeps policy very tight, just to grind inflation down from 3% to 2%, it's not just unnecessary, it's actively harmful for households, small businesses, and the bottom half of the K-shaped economy. So what do we do with all of this? I'll give you a few takeaways. Number one, don't invest from the rearview mirror. If you're waiting for lagging data to confirm what markets already know, you're late. Number two, expect more volatility in risk assets. Tight policy and positive real rates and global liquidity contraction are not a calm backdrop. Corrections are part of the regime. Think in K-shaped terms. Your customers, employees, and investors are not living in the same economy. Wealthy savers and younger leveraged households are experiencing completely different realities. Number four, watch the Fed's behavior, not just its words. The real regime change will show up in how they balance employment, inflation, and long-term rates, not in the press conference and sound bites. And number five, position for a world of higher average inflation and lower real yields over time. Monetary debasement and financial repression are not academic. They're the logical outcome of the math we've walked through. To wrap this up, risk assets are correcting because the Fed is still too tight, too backward-looking, and too slow to adapt. The Powell Fed's track record is littered with late moves and missed signals, And the institution now needs a structural regime change, one that hasn't started yet and will fall to the next Fed chair to execute. If this episode helped you make sense of what you're seeing in the markets, share it with someone who's trying to navigate the same environment. Make sure you're subscribed to the Limitless Wealth Method podcast on Apple Podcasts, Spotify, and YouTube so you don't miss future episodes. I'm Jason Hilliard. Thanks for listening, and I'll see you in the next one.